Traders, welcome back to another lesson. Today is part 3 out of the 4-part series of short put selling. Today we will be going over Theta Decay and also various trade management strategies. We will include talking about rolling the options when the trade goes wrong, taking assignments when we want to buy stocks at a discount as we mentioned in part 1, and also various profit-taking strategies when the trade goes in the right direction. By the way, I have a free short put mastery guide. I combine all the teachings from a seminar I paid $5,000 a decade ago into one ebook. You can get it in the description below. Let's talk about Theta Decay. The symbol for theta in the Greek alphabet, it's a circle with a line in the middle. You will often see this symbol throughout your trading platform. Let's talk about what is Theta Decay. It is the rate at which an option's extrinsic premium value decreases as it approaches expiration dates. Okay, so if we look at the chart here, you can see and it shows us that time decay starting at 60 days speeds up quite a lot. You can see that this line right here, it is not a linear line. It's an exponential line. And this is the reason why we like to sell around 30 to 60 days. We want to take advantage of the fast theta decay. We want our premiums to decay. As a seller, if it decays, then we can buy it back at a cheaper price and we make more money. Between the 30 to 60 day mark, theta decays fast, so we make money faster. Let's talk about how theta helps us. I'll give you an example here. Say the stock is at 100 bucks. We decided to sell the 90 strike put for 100 bucks in premiums. This is premiums, okay? In premiums. Every day the theta decay is $3. Okay? So in 30 days, approximately almost 100 bucks. Theta increases a little bit. It's not steady. It's not a static number at 3, by the way. Theta decay happens regardless of how the stock moves. Whether your stock moves up or down or sideways, the premium always decays. It will always be going down. So say we open this at 100 bucks. In 10 days, the short put is now worth $30 less because 10 days times 3 is 30. We will make $30 from the premium portion of the extrinsic value decay if we buy back the short put. That's how we close the trade and take profits. Now, let's talk about the various trade management strategies when we deal with selling puts. The first one we'll talk about is how to take profits. After that, we'll talk about how to take assignments and how it works, because in part 1 we talked about how sometimes we want to buy stocks at a discount and we do that through assignments. Now the third thing we're going to talk about is rolling. We're going to talk about the 2 scenarios when we roll. The first one is when we're losing, and the second one is when we only have 21 days to expiry left. Let's talk about the first case of taking profit or exit. Okay, when you are selling short puts as a bullish strategy, when you only want to go for income and you are not trying to get assigned, you're not trying to buy the stock at a cheaper price, this is the way you take profits. You exit at 50% profit. So if we collected 100 bucks in premium, when the premium is only worth $50 left, we buy it back and we're gonna earn $50. Okay? Or when there's only 21 days to expiry, whether it's a small win or a small loser, we close it. The reason behind that is because there is some gamma risk. I'm going to be explaining this in another video. This is a big topic itself. But just remember, we don't want to hold our short puts past 21 days. Case number 2, assignments. Sometimes we want to own the stock at a cheaper price, as we mentioned in part 1. This is a very nice strategy, and it requires us to get assignment on the stock. So we will not be exiting when the short put is losing, quote unquote losing, okay? Sometimes you may see a few 1000% red. It will look scary, but you just ignore it, okay? And we'll take the assignment at your predetermined planned strike price. So example, we sold a short put at $90. If the stock goes down to $85 or lower, you do nothing because we want to buy the stock at $90 when we get assigned. However, sometimes the stock will not go down and you can tell you will not be able to get assigned. You can't buy it at a discount. So if it blasts up, you want to take profits because it is not worth wasting buying power as the assignment is unlikely now. If it pops up to 80% profit, we're going to exit. So what that means is if you collected $100 in premium and then after some time the contract is only worth $20 left, we're going to close it out and make $80. Take the money and run. So our next case I want to talk about is rolling our losing positions. When do we use this? We use this when our position is losing at 21 days to expiry. So how do we do this? We will be buying back the short put first, and then we're going to be reopening another put further out in time, usually the next month. So about 30 days. 30 days out. You can choose the same or a lower strike. This is very important. You should always be collecting credit, so you should get paid for rolling out in time. Think of rolling as a trade like extending your reservation at a hotel. You get to keep your spot, but we're adjusting the timing for better outcomes. Let me show you an example. Here we have silver, SLV. See, right now we have 21 days to expiry left. And we sold something, let's open this up. So 22 days left. Say we have a contract here and we sold a put a while ago, maybe 30 days ago for the 70 strike. And we are so wrong because right now silver is at $61, way below our 70 strike. We're way in the money right now. And at 21 days, I still think I want to keep this position because I think silver will bounce back within 30 days. Or I want to keep collecting premiums because the IV is high. Whatever your reason is, this is how you roll. So you're going to buy back this 70 strike for about $9 something, $9.20. And then we're going to go out further in time, about 30 days. We're going to look at the next monthly contracts, 50 days right here, May 15. Open it up, find the 70 strike, and we're going to sell it. Now you just extended your trade by 38 days. Sorry, by 28 days. And at the same time, if you notice, you're even collecting a credit for this maneuver. You're getting 1.75 times 100, that's $175 in your pocket for being wrong in this trade. Isn't that incredible, traders? Now, you can also decide to roll your strike down. So you bought back the 70 and you can roll it down. Say, I only want to be at 68 now. That's fine. The most important part is you're collecting a credit. So if you roll down your strike to 68, it's easier to exit in the future, but you will collect less credit, as you can see. Only $35 if you roll it to 68 versus if you keep the same strike, it's $175. So there's some give and take there. All right, traders, that's it for today's lesson. If you have any questions, post them in the comments below and I'll try to answer you as soon as possible. And don't forget about the free guide. Check out the link in the description to get your free copy of the Short Put Master Guide. I hope you enjoyed this lesson. Like and subscribe, and trade small and trade safe.